Good morning. Welcome. I'm Jonathan Schein with Institutional Real Estate, Inc., and welcome on behalf of our sponsors, Thor Equities and Juniper Square, to Life Sciences Investment Climate 2021. I'd like to introduce all of our panelists, including Joe Sitt, CEO of Thor Equities, Bill Hunter, who is our life sciences expert on life sciences, as well as an illustrious group of investors, Brian Coombs with Brown Legacy, or BLG, Tony Breault with State Treasury of Oregon, and Bert Hoek of Invest. And what makes this very exciting today is, first of all, we have three different types of investor disciplines. We have a family office, state treasury, and a global investor. And we have over 600 people registered for today's event. So obviously we're touching on something extremely important, certainly at this time. So I'd like to kind of set the table with Bill Hunter kind of giving us a primer, about a 90-second primer on what life sciences is and what it is not, because there are a lot of questions about it. So Bill, let's set the table right now.
Thank you, Jonathan. And again, thank you for my fellow panelists and for everybody joining today. It's a great question. I think when we look to set the table for today's discussion and really try to understand what life sciences real estate is, I really take a step back and prime this with, most of us have probably read the market reports and the industry reports articulating what life sciences real estate is. And that's from CBRE, Cushman, JLL, and our friends at Newmark. Most of that has to do with infrastructure enhancements to buildings, right? So you've got ceiling heights, enhanced power, HVAC, vertical shaft banking, which is critical, and then really distribution and demarc logistics. Those are things that I think everybody's generally familiar with for the most part. I think today we want to take a deeper dive into really what's the future of life sciences real estate investing. It's a good point, Jonathan, to mention what is life sciences real estate not, and that's really important. So when we look at that, it's not medical office space, it's not hospital space, it's certainly not surgical centers. The life sciences vertical is one that has been around for over 20 years. And some of us have worked in it on a deep basis for that tenure. There's a lot of people rushing into the space now. So I think that this panel will be a great opportunity to share kind of where the investment lies and how that works. Back to you, Jonathan.
Thank you, Bill. Thanks for setting us up like that. Now, I'd like to start with our investors because, as I said, they all come from different disciplines. And I'd like to, first of all, start with Tony, and then I'll go to Bert and to Brian to find out, what is your investment thesis at this time, how much you have at AUM, and what you're devoting to real estate at this time. So then we can get into why you're looking at life sciences at this time. Tony, let's start with you.
So for backdrop, the Oregon real estate portfolio just crested over about $9 billion in net asset value, the bulk of which is roughly 65 to 70% core, the remaining 30% in non-core, or how to create core. So this stage, the life sciences has been a 2 or 3 year endeavor for us, in which we've towed in through some sidecars and programmatic, more passive investing alongside different funds that are already in the portfolio, just to learn the different risk parameters and diversification plays that it may be able to provide over the long term. So like any other niche sector, this is, while long-term for other groups like Thor, it's been a newer asset class for us to try to figure out how to diversify income streams and return patterns.
Great, thank you. Bert, welcome.
Yeah, welcome. Thank you for having me. And so Bouwinvest is the manager for the construction pension fund in the Netherlands. We have a 20% allocation to real estate, accumulating to about 13 billion euros in real estate investments globally. We invest both for financial returns and for the benefit of society, so social returns. And healthcare is one of the pillars of that strategy. And that's how life science fits well with our beliefs.
Okay, thank you. And Brian.
Thanks, Jonathan. BLG Capital Advisors, we're an investment office backed by a single family office based in Chicago. I work on the real estate team and we invest across all sectors except for retail. We're not allowed to disclose AUM, but I can tell you we have a 30% allocation to real estate throughout the portfolio. And we invest across funds, co-investments, and direct investments. You know, life sciences is a new investment sector for us. You know, we started looking at it in late 2018. Throughout 2019, we did our first investment this year in 2020. In terms of investment program and thesis, you know, we're targeting opportunistic returns with as little risk possible. And so we've tended to gravitated towards niche sectors where there's more limited competition, higher barriers to entry, low vacancy, and you know the ability to underwrite to a strong yield. Back to you, Jonathan.
Thank you very much, Brian. So Joe, I want to come to you as you are the CEO of the organization, and we're looking at life sciences. This is a relatively new industry to real estate. Now you have 3 investors on this call, on this webinar. What questions should they be asking outside of returns? What kind of questions, if you were just an investor, would you want, as a manager, would you want to hear?
First of all, it's a pleasure. Thank you for having both Bill Hunter and myself from Thor Equities today, and the esteemed panelists and the esteemed LPs that you have joining. Thor, as a company, has been in this space for about, I would say, 6 years. It's an evolutionary process, which if you want, we could share why we ended up in this space. But more particularly, to answer the question that you just asked me, it's really expertise of the LPs and the LP managers. This is not your typical commodity real estate type of asset. I often liken it to the hospitality business in terms of having particular expertises and particular management and the intensity and the operational intensity of it. While we've been in the business, myself and Bill Hunter, even more than me, even prior to his joining us a few years back at Thor Equities, is the knowledge of the technicalities that are required within the space. And all of a sudden, this has become, I guess, in the post-COVID world, the new fad, so to speak, over the last 60 days or 90 days. And when we look around at the folks that are entering the space, be it in the last 90 days or even in the last 18 months, more particularly, we're seeing people chasing an opportunity that they're hearing about, but candidly not having the expertise in the field. And for example, when it comes to tenant relations and marketing to tenants, more often than not, we're normally inheriting or winning the bid, so to speak, or the RFP with the life sciences tenant, more particularly because of their comfort with the expertise of the team, as opposed to just somebody saying, I own the real estate, I've never done it before, but it's a space I like.
Thank you. And let's kind of touch on that topic as expertise, because it's still a relatively new industry to the real estate industry, of course. Now, to the investors. So there's a lot of activity right now in terms of life sciences. Every day you read another story, another deal, as Joe alluded to, chasing deals. Is this a flavor of the moment during the COVID era as it is, or the post-COVID era, or are we looking at something that's accelerated, or is it something brand new? Brian, I'd like to start with you on this.
Sure, thanks, Jonathan. No, I think it's here to stay. You know, I think one of the biggest, you know, when we started our research mission into life sciences, one of the things that jumped out the most to us is that life sciences employment across the US has doubled over just the last 10 years. I don't think there's almost any other sectors besides maybe e-commerce that have grown that much. And this is long-term growth. Most of these are large, you know, billion-dollar plus companies that are leasing the space, and some are getting money from the National Institute of Health. And I just don't see it going away. I think there are some small risks of oversupply to certain markets that could cause a year or two of, you know, maybe lower rent growth. But I think this is a long-term sector that will be here to stay. Okay,
and Bert, I know that you've just kind of entered the market. Maybe you talk a little bit about that.
Yeah, no, I think I agree with Brian. It's a phenomenon that's here to stay. And besides the more obvious demographics like aging and therefore a higher need of healthcare, it's really also you know, the fact that 18% of the GDP in the US is healthcare system based. we're really plugging into a large portion of the economy. And that is also evidenced by the increased research spending that not only induced by COVID, but has been taking place for quite some time. So we are a long-term investor, and we believe in the long-term fundamentals behind life science.
Thank you, Tony. Now, you just mentioned that you just got into this 2 years ago. Were you that prescient, or was it something that had been percolating for some time?
I think it's a nuanced answer. I would probably put a nuance onto the previous answers, in that real estate folks just can't help themselves in trying to create supply and demand bubbles, give developers enough opportunity, and over a supply of capital will flow into the sector. I think right now we're in an unusual environment in which there's no visibility to cash flows in the primary food groups of real estate. So life sciences is certainly a benefiter, and you're going to see folks that probably haven't tried in it before becoming subject matter experts by their own vision, and perhaps not with the history and depth that other groups have had. I think on that front, maybe the real answer for Oregon was not any smart choice. We tend to find ourselves with a herd no matter how much we want to be intelligent. And I think in that area, we were looking at much more of the TAMI or tech, or whatever you want to call the technology and growth hubs that come out of educational nodes. And that put us on the back door for many of the life science sectors or clusters. And so by default, we ended up with a number of office assets, particularly that had a life science component. And we started looking at that and saying, okay, there's a little bit different income stream that spins off this, and should we be towing in more and more and learning the sector? And it is until recently that we've determined that, similar to both Brian and Bert, that it's got a more permanence, and what that sizing should be, I don't know.
Hey, thanks, Tony, and thanks for that nuanced answer about real estate professionals. We all love.
I just like being the outlier.
So Bill, Brian and Joe hit upon two things kind of together, but separately. We're talking about the tenancy itself, right? And these are experts, and that's one part. How do you find the right operating partners within these built for life sciences, as well as maybe you can touch upon a little bit the NIH funding, and apparently that's a big part of what goes into the tenancy of a life science.
No, it's a great question, Jonathan. Thank you. And you know, taking a quick step back to Joe's point earlier, you know, Joe identified this as a niche that he wanted to be in quite a long time ago, and I was introduced to Joe, and we worked very closely together to build the Thor Sciences platform, along with the rest of our team that spans from the East Coast to the West Coast. I think Brian and Bert made some really good points about employment statistics, as well as something that Bert touched on to just bring that to the forefront, is really the grain of America. When you look at over the past 10 years, the grain of America is a phenomena that we really have built the foundation of life sciences investment on, because as the population ages and life expectancy continues to get more and more, people are living longer. The bottom line is people are living longer. And that said, individuals over the age of 60 take 6 times the medication individuals living under the age of 60. So that base fact has really propelled the life sciences, the pharmaceutical, the biotech, the medical device industries forward at a rapid pace. And that I don't see an end to that in the future. As far as supply and demand logistics, all of the markets that Joe and I track through Thor Sciences, you know, we're looking at, for the most part, for availability, a sub 5%, many markets sub 2% availability for true in-kind laboratory space that's ready to go. And with those supply and demand logistics, it's a great investment vehicle today and for the foreseeable future. When we look towards our partners and what's an attractive partner, it's a partner that understands the dynamics of the industry. This is a unique real estate vertical that you do have to understand your tenancy. If you don't understand your tenancy, you don't understand how they matriculate through the discovery and the R, let's say, in research, through the D, development, manufacturing, the commercial scale up, through pilot, and then to that commercialization level of manufacturing. And we at Thor Sciences, we are very bullish in all aspects of that continuum, from the R through the D, and that development. To quickly touch on the NIH and the government funding, it's not just NIH, it's also DOD, FDA. There's a lot of different funding mechanisms from a federal level that support this industry, and in many cases actually outweigh the VC world. And that being the case in this industry, there's multiple vehicles for funding that we look towards when we underwrite our tenant base. So Jonathan, I'd love to learn more about some of the investment appetites through Tony and Bert and Brian from that perspective as well.
Well, thank you for that. And also, I just want to encourage our audience that there is a Q&A button at the bottom of your screen, that if you have any questions, please provide them. So Brian, Bert, and Tony, why don't you work with Bill and answer some of the questions he had? And I also have a question is, what kind of investment, what kind of return horizon are you looking for when you invest in these kinds of projects? So Brian, what are you looking at?
Thanks, Jonathan. We typically underwrite everything to a 3 to 7 year hold at BLG. And, the life science investment that we made this year is expected to be between a 3 and 4 year hold. It's all ground up development. We're targeting 20% plus net returns, and, hope to be out of that between 2023 and 2024. As we look at other deals, they're all kind of similar timeframes, 2 to 3 year build cycle, 18-month stabilization. And then, our business model here at BLG as an opportunistic investor is to typically sell at stabilization to lock in a attractive IRR and a gain.
Bert?
Yeah, I think I totally agree with Bill and Joe here that this sector is different and it requires the right operator that is part of the whole investment as a platform. So we were really looking for operating partners that were very much an expert in the sector rather than looking per se for assets and then following that with perhaps the resources required as in the traditional real estate investing sense. And hence that's really where the focus of our search was. I also agree with Bill that the fundamentals are really strong in those clusters that where we were looking to get exposure. So we were not afraid to add the development exposure to the mix, and hence this is how we that's how we were looking for gaining exposure to the sector.
And Tony?
Yeah, similarly to both, I think the fundamentals are in place for this to be there. Part of the issue we've had is a over allocation or exposure to traditional CBD office, which is inherently both volatile and inefficient. So how do we create a denominator effect to bring down those exposures rather than force selling of those assets? And one of the thought patterns was bringing in a larger exposure to life science to diversify our office holdings and let that part of the portfolio grow while we stand still in our traditional office. So I think it's still a bit of a learning curve on our end to determine what's really strategic versus not, and then what is the risk, appropriate risk return profiles given this low yield environment we find ourselves in, and everything from cap rates compressing in this sector over the last few years, more entrants coming in. I think we have to learn through the experts out there what that entails.
And just to be clear, you're right now just doing separate accounts. You're not investing in funds, correct?
No, about 30. I did a wonderful job of over-scripting to the market that we weren't in funds. About 30 to 35% of the portfolios in closed-end commingled funds. It just was a repositioning for about 5 years to flip the core around from a 30% to 70% or so allocation. So given that backdrop, we're now looking at funds and commingled vehicles and where our repatriation of capital part of the portfolio is allowed. I'm just not certain that it's an opportunistic sector or not. And we like to always think that anything we do opportunistically has a strategic long-term advantage that we can seed our portfolio with long-term, good, resilient assets. So again, a lot of homework still left to do.
It looks like we're getting a lot of questions from our audience, which is great, and which we encourage. And a lot of them are actually real estate questions. So why don't we go to the most basic one that there is, basically on location, location, location. Where are the best markets? And obviously the best markets are the most competitive, but is there an even playing field? Are there other parts that are not in the science markets that can be good for life sciences? Bill, Joe?
Joe?
What's exciting about the space, if I can start a little bit higher up, is Tony's comments earlier on were really valid. You know, just describing the real estate industry and how money moves into a space. And, you know, we all know what happens when it gets overserved. What's exciting about this space is it's still, yes, we've been in the business now for 6 years. We entered this space because we saw the same things we saw back in the year 2006 when we entered, or 2005, when we entered the tech office space, or back then the .com space, which was a lack of interest, a lack of venture capital funding, et cetera, et cetera. And what people have started to wake up to was the quote that we used to use when folks asked us why we entered this space 6 years ago, was that what we saw was a space that had the same growth potential over then the next 25 years as what we saw in the technology industry over the last 25 years. And coming back in terms of locations and real estate, et cetera, what it means is that almost all the markets are underserved. Yes, Brian said a little bit earlier that there are some markets a little more is coming into, but it's really all that have the satellite, that operate as a satellite to institutional educational institutions that have the best and the brightest brains for the particular spaces. And we're starting to see some periphery developments, meaning folks trying to do life science just because that don't have that infrastructure. Some of those type of locations concern me more, but it really is all of the educational institutional markets that have that anchor to it. And so many of them are the obvious, as you guys started to enumerate earlier, and as you often hear, a Boston or San Francisco, et cetera. Where we try to be different is things that are somewhere in between those two types of markets. For example, I think in the state of New Jersey today, we're the largest landlord in the life sciences space. And why? Because it's close enough to those educational and medical centers, let's say right here in New York, but still so extremely underserved. And because of the cost of operating in New York City, so operating in New Jersey. And then last but not least, there started to be somewhat of a community happening there already. RTP in the Carolinas is another great example of that, where you're getting community.
Thank you for that. And also New Jersey is well known for a big pharma state as well as a logistics state. So it's got a lot going for it in terms of that. And of course, there are other markets as well. Both Rochester's, Minnesota, and New York have those kinds of facilities as well. So I'd like to go back to the investors and talk about some of the investments you've made recently. I'd like to start with Bert, because you made there was some big news in the last few weeks. Love for you to discuss it and why that particular investment in general.
Yes, so we announced we participated in the recapitalization of Blackstone's holding in Biomed Realty. They sold it out of their opportunistic funds and created a Core Plus open-end fund vehicle for third-party investors to join. We were particularly attracted by the very focused portfolio around these core clusters, namely Boston, San Francisco, and San Diego, as well as Seattle. They had actually, over the last 4 or 5 years or so since they owned it, been increasing the focus of this portfolio to those particular cluster markets. And these are really micro clusters within those cities around the universities where, biomedical scientists tend to gravitate, as well as having some strategic land plots to further develop those areas. So that was our attraction, as I mentioned earlier, of course, with Biomed, the team as the operator tied to the investment.
Thank you. Brian, you're doing some new things.
Thanks, Jonathan. Yeah, this summer we were able to participate with the IQHQ transaction that I'm sure many of you guys have heard of, which is a life sciences company based in San Diego, run by Alan Gold, Tracy Murphy, and Steve Rosetta. And this is probably the fourth or fifth life science investment that we underwrote, and the first one that we executed. And there's a range of reasons for that. You know, I think the first and the biggest, as many people here have said before, that the execution is critical, and the quality of the management team, their relationships with tenants is really paramount. And IQHQ, led by Alan Gold, has a 30-plus year track record in this sector, and we found that to be extremely enticing. And then furthermore, they had a large seed portfolio of assets in true AAA locations, in downtown San Diego, downtown Boston, things that we could touch, feel, underwrite, and truly get excited about. So we were able to close that this August, and are part of the company and excited for the future.
All right. And Tony, what are you involved in right now?
Ours is still early stage. Our first foray in order to make a better toe in the water, I guess, for the learning curve associated for our staff, was a more passive investment structure that provides co-investment capital alongside a group out there that specializes in this life science sector, one of a few different niche areas, and allows us to work from development all the way through core stabilized with staffed opt-in provisions to say, yeah, we have appetite for that, let's move forward. So our first one was really a development opportunity in the Bay Area, San Francisco, near Berkeley. That's a life science kind of a node, and a little closer to what I would call a triple net transaction but with a life science tilt towards it.
So the question I have is, and we're getting, as I said, a lot of real estate questions, and if some of these questions are not answered during this webinar, our experts will follow up with you, so please be assured. We're talking about real estate now, and you even mentioned a triple net lease situation. Are most of these deals, obviously they're new development, are most of them kind of built to suit, or do you find a tenant or do you build it and they will come? I'd love to hear Bill and Joe from your perspective. Are these things pre-leased essentially?
That's the catch-22. I would say overall in real estate, one of the trends we're seeing in a post-COVID world is people want things where the owner developers are investing in the build down in advance and giving it to them turnkey. And that's starting to filter down into the life science space with the same type of demands. The problem there is getting, institutional partners comfortable with spec building investments into the life science space. And not all of them are so comfortable with it. Ourselves, we work with a number of different institutional partners with varying degrees of appetite for risk. And we're going through a process, I would say right now, with some of our partners and or potential partners in the space to get them comfortable with somewhat, I would call it a hybrid, where we're able to show a strong tenant interest in a particular location based upon conversations, et cetera, to give them that comfort to make that leap forward. And or we're doing projects where we've got a core of a good income coming in from a particular building, but it's got land to be able to expand into. So the cap rate wise, we're going in with a good return to mitigate their downside risk, but at the same time, then could give them the hope certificate of the dream based upon us doing the pre-development or pre-construction work, completing that pre-construction work in advance, and then showing it to tenants, and or in some cases getting our investors comfortable that we have got so much income from the first buildings in that particular property that we're buying, so that they have the comfort to allow us go ahead and spec it. So to be candid, it's so much is driven, the demand is there very much from the tenants today. If you're willing to do it, build it, they will come. It's more us getting our institutional partners comfortable on the other side in terms of taking that type of risk, particularly in a space that they're not used to.
Well, no, that's a very good point. And I'd like to bring Bill into this conversation, because another one of our questions is, who's responsible for what, right? Is it the tenant that's responsible? Is it the owner that's responsible? Because you have institutional investors investing in this, and the last thing that anybody wants is some microbe breaking out into the world, and we're facing another situation. So who's responsible for what?
No, it's a good question. And just to build on what Joe is talking about, you know, the tenant base in life sciences traditionally does a terrible job at planning. They look for space when they need it, not proactively. So it's very much a knee-jerk reaction to a funding mechanism or the success of a specific therapeutic product or category that they're going after, and then they need space immediately, whether that be large molecule space for biology, small molecule space for chemistry, or production space, as I talked about before, with that, you know, research and D, the development and manufacturing space. So to really create the platform that we're doing at Thor Sciences, it's making that investment for properties that can be quickly adaptively pivot or adaptively reused to a specific life sciences use. And the key there is creating an adaptive reusable facility that can withstand a lot of different research functions. You know, between the research and development, that's kind of where the line is drawn. But research, you can do that pivot from biology through chemistry, and then production space kind of is its own animal. And that's something that we pride ourselves at Thor in knowing very well. So when we look at that product type, our investment and our partners and investors' investment in the space is in that core and shell, so that the finishing touches can be a co-investment from the tenant into our product that we continue to own and manage and operate. So that's a significant distinction between this vertical and this niche and other categories that we invest in.
So there must be a tremendous TI expense to put this together.
The TI that we try to focus on is what can continue to be reused, right? There's a high barrier of entry for the specifics of what the tenant is doing within the space. But that final customization is done by the tenant. The special sauce that we've got is understanding how that can be reutilized throughout various tenants. As you know, and everybody can speak to this, the tenant base can be doing great, but then in a phase 3 trial, lose everything if the product does not get to commercial scale. So at that point, what happens? At that point, there's kind of a retrenching, and then when we look to relet that space. We've got the ability to do so because we understand how we can pivot within the existing investment that the tenant has co-invested with us and our partners' equity.
No, thank you. So investors, what scares you about this particular investment thesis? Tony, what questions do you have that you usually ask when making this type of investment? Something's got to scare you.
For us, it's always trying to look through an investment horizon or through a cycle. And one is understanding the big picture concept that we led into this discussion earlier with, which is just the longevity of it. Is there a strategic role within the portfolio that'll look out through market cycles? And then 2 would be the return and risk profiles needed to achieve that. And are we taking on too much risk to get a lower return? Maybe that's pervasive across all asset classes. And I think 3rd is just what you brought up. At the end of the day, it's always the highest and best use of the land, to the extent that we have a good life science property. If it can be converted to something else because it's got demand in that environment, then wonderful, we've pegged everything.
Brian?
Yeah, thanks, Tony. Thanks, Jonathan. I would say the biggest concern on our end when you look at this space is just how much it costs to build these buildings and what goes into the development execution. You know, we do a lot of industrial development here at BLG, and you're basically laying a foundation, putting up 4 walls and popping a roof down. It's 60 to 80 bucks a foot. On these life science buildings, you're looking at base building costs of 600, TI packages of 150 to 200, tenant cost and spend another 300 over that, and you're at 1,200 bucks a foot in a basis. And I just think that's a lot more stuff to screw up than your traditional, warehouse or development. And so when we look at it, that's our biggest concern. And the way we mitigate that is by picking the groups with the biggest, longest track records and not doing just one project. Getting some diversification within the sector.
So even emerging big life sciences companies have the same problem as emerging managers in this market. So Bert, what are the things that concern you within this particular sector?
Well, it's a bit of a luxury problem at the moment. So you have triple net leases with 3% escalations typically, and the market growth, if you look across the board in the past 5 years or so, has been 6%, 8% per annum. So even at your next renewal, as long as you have indeed done the adoptive reuse TIs up front, you can capture that rental growth. Now, that's almost sounds too good to be true, and there's going to be a lot of capital, a lot of people starting to jump on this bandwagon, and supply is going to come in. So for us, supply risk was the main issue that is going to temper this rental growth that we have seen to date to a more reduced number. I think we feel still good about the timing, but down the line, that's our main concern.
Okay, so oversupply has been a lot of our questions have to do with oversupply, and I'd love to hear from Bill and Joe. Like, how do you mitigate that particular risk? I know, Joe, you talked about going into basically secondary and possibly tertiary markets where there are universities and science centers, but when you're a leader, people are chasing you.
I would say it's not so much being specific to individual markets, although there are markets that Bill and I like better than others. I would say it's more speed to jump on the opportunity. 6 years ago when we started in the space, we said we may not be the first people in the space, but we're going to be the fastest second. And I think that still applies today. What the expertise and the team and what we've developed within Thor now has provided us the opportunity to mine the opportunity today. And as I often tell investors, we had one institutional investor in particular that was backing us with the volume of deals that we were doing today programmatically. And now I guess they're European based, and I guess because their denominator effect or numerator effect went out of line because they're public securities. So they've got less dollars to put into space. So we've been out in the marketplace looking for a new potential programmatic partner. And one of the pitches I always tell people is the name of the game is speed. More often than not, when we're out there with institutional partners that we're partners with in other categories to then look at life science, the response to us is, let's wait a little. We'd like to give it a few more years to see how that industry evolves. And my answer is, by the time it evolves, quote unquote, or evolves to the point that you're going to have interest in the space, the opportunity, the returns, they'll still be there. They'll still be fabulous. As I said, from 6 years ago, I said, and I still hold by it, it'll be a 20-year, 25-year wave of opportunity, but the returns are going to be drastically mitigated. So my comment is not so much on particular geography as much as speed to marketplace to be doing and mining these opportunities now, while the demand from tenants is out there is now. And it really is in all markets that I view the opportunity that you think of life sciences.
So Brian, you just brought up a little earlier that you're looking like for a 4 to 7 year horizon on your investment. Is that what your thesis says, that by that point the returns won't match up what you need?
I say it's too hard to see that far out, Jonathan, because it's going to be totally dependent on the supply. I feel really good that demand will be vibrant and strong and will continue to grow over that time frame. But if an unbelievable amount of product gets built, it won't be a great investment in 5 years' time. And so I think we have to wait and see. We feel really good about the fundamentals over the kind of 3-year build cycle that we're looking at. And, we'll reassess the opportunity at that point in time.
Okay, well, thank you. So I'm going to pivot a little, and I'm going to go back to something, Brian, you said earlier, because this has a little less to do with life sciences and more to do with the state of the world. As all of our audience can see, it's not exactly the most diverse crowd you've ever seen on a panel. And we're aware of that. And diversity, equity, and inclusion are certainly an important and impactful part of the marketplace and industry in the world right now. As life sciences is now a niche within a niche, do we see more opportunities for those who are not like us to invest and become CEOs and executives in this market? I'd like to go to Brian. I think you have some anecdotal evidence just in how that's working. We're just going to stay here for a little while. I just want to make sure that people understand we understand.
Sure, absolutely. Thanks, Jonathan. So, diversity and inclusion for BLG is important. It's not a requirement, but it is something that we see as a positive. I'd say in the life sciences sector, we've seen a decent amount more engagement of women in senior operational roles, particularly compared to industrial or office real estate, which is super exciting. As you know, IQHQ has a female president, which we find to be a big plus. And, it seems that the life sciences sector is doing a little bit better job than industrial or office in terms of incorporating more diversity and inclusion.
Oh, great. Thank you. Bert, how do you see it? I mean, you're from Europe, so it's a whole different experience.
Yeah, and of course, D&I is also a big topic. I think for us, the scale really went more to the S and healthcare, and the benefit to society, providing the facilities to cure diseases for human mankind, particularly in COVID times. That was more of the the main argument for us on the ESG side, and to broaden it out away from the S, the E in life science buildings is also for us a key determinant to invest in the sector, as particularly the newer developments are very well suited to gain LEED standard and mostly LEED Gold standard environmental.
Thank you for that. And Boinvest was also actually one of the progenitors of the GRESB
yes.
benchmarks, and I don't know where life sciences fits in that yet. Maybe it doesn't, or it does.
That depends on the sponsor, I think. Okay. When we went with the manager, we were confident coming from their other GRESB participations that they will do that for this particular strategy as well.
Okay. And Tony, D&I?
Yeah, I think since we have a plans or a sponsor or general partner of one in this sector, I don't have a large data set to compare and contrast. I think part of our process was much more focused on the sustainability, environmental aspects of it, since we weren't diving down into the tenant and corporate mix-up of the end users. But to that end, it's not dissimilar in our viewpoints to what the broader industry is trying to deal with.
Thank you. Well, yeah, Joe, please talk about from your side of the business.
I think that because we're a forward industry in the life science, I think we're forward thinking in terms of the sustainability. We're more green conscious, I would say. But I would say where our industry is weak and lacking is probably the diversity side. I think real estate in general. I'm often, talking about folks being more focused on providing opportunities for Latinos, African Americans, and women. I mean, it's shocking, the dearth of women, even more so than Latinos and African Americans, surprisingly, in particular in the life sciences. And it's a great space. There should be no reason, no justifications for otherwise. And for whatever it's worth, at Thor, I'm actually the only male member of our senior most executive team at Thor. So I'm surrounded by women every day. So I guess by fusion of us entering the business will change the averages of the diversity side.
Well, that's the hope. And thank you for just allowing that part of the discussion to come through. Another question about tenancy, actually, and this comes for the investors and for Thor as well. Do you have a preferred type of tenant, such as R&D versus the manufacturing part of the life sciences sector? Is there any particular, are you agnostic? Is there a favored nation status? Tony, you do some separate accounts. When you invest in this, what are you looking at?
So far our exposure has been limited to the R&D and more office component or I guess we've had a few of the more traditional woody walk-up flex industrial that has a component of both, but it has, we've had no exposure to the manufacturing end of it just yet. I think that's more of an offshoot of the industrial or logistics sector with highly specialized needs within there. But so far, that hasn't been a focus yet.
Okay, thank you. Brian?
Thanks, Jonathan. Yeah, we have not done any manufacturing. Everything that we're under development with IQHQ is going to be research oriented and, kind of AAA CBD locations where I don't think it will ever make sense to manufacture given the cost of land and space there. But perhaps, maybe more tertiary markets could provide opportunities in the future.
And Bert, what kind of tenancies are you looking at?
Same here. It's primarily research lab space. We did look at the overall tenant profile and credit worthiness. The larger users with longer leases tend to be also the credit worthy tenants. In our particular portfolio, we had 45% investment grade tenants in the portfolio.
So Bill, how do you vet these tenants? What are you looking at? R&D, manufacturing, a combo?
We look across the board as far as R&D. Again, we use a nomenclature with the R, research, D, development, manufacturing. Sure, the more digestible area of this platform is within the research. The research tends to be a lower threshold of investment, a lower threshold of knowledge in the space, and that leads you to think that that's more adaptively reusable in that research component. I look at, and Joe and I and our entire team throughout the country at Thor, we really look at the spectrum of R through D. And the reason being is that when you truly understand the granular nature of the space, the manufacturing is not that much more complex than you would think, and there is an adaptive pivot able to be made within the manufacturing. Generally speaking, the manufacturing falls under either a small molecule, traditional pharma, large molecule under a biological manufacturing. And when you look at the dynamics of the real estate, there's not a huge chasm between the two if you truly understand what you're looking at, and you can understand where the industry is trending. Right now, we're looking at all the vaccines and therapeutics that are of a biological nature. And when you've got that baseline infrastructure for that manufacturing, it's very adaptively reusable. How we underwrite our tenant base, we're not scientists, but actually we do have Tom Nishioka on the West Coast for Thor, who really is the founder and the thought leader at Thor Sciences. Tom is a scientist. That being the case, when we look at these tenants, we're underwriting the management teams. Generally speaking, the management teams are serial entrepreneurs that have been in the space. They either come from big pharma, big bio, and when they do a project great, they're rewarded, they're bought, and then after their lockup period, they go and do it again. And a lot of times we see these individuals, they're on their third, fourth gyration of their specialty. That being the case, that is really our core focus when we're underwriting a tenant, is understanding what their pipeline is. Obviously, pre-clin, phase 1, 2, 3, commercial products. But then when we look at the management team and how they've surrounded themselves with other experts that they've come to know for over 20, 30 years. And that's really the core underwriting parameters that we use when we're looking at the tenants.
I'd add one more sentence to what Bill just said about how we operate at Thor Equities or Thor Sciences, or two. One is, as he started to allude to, we look at this in a bigger picture. We're in chemical, bio, battery, robotics. So we look at Thor Sciences as a little wider than most people think of the space, so to speak. That's why we're not called Thor Life Sciences, but called Thor Sciences. And then the second thing, more particularly, is we started off, as I started to mention before, in about 2006, we reinvented our business-to-business side of our business from commodity office to tech office. And the biggest variable for us was underwriting the tenants, because so many of the tenants from 2005, 6, 7, 8, 9, you were underwriting tenants trying to guess whether or not they'd be successful. And so the same thing has happened with us starting 6 years ago in the life science or the sciences space. We really operate like venture capitalists, and not looking at ourselves, as crazy as it sounds, as being in the real estate industry, but more particularly being in the venture capital industry. Now, I will tell you, to knock myself, while we've done well in the space for the last 16 years or so, I think about tenants like Dropbox and Twitter and Okta, and man, if I put $1 in their private investments, for every $1 that we invested the equity on the real estate side, I think we probably would have made, no exaggeration, 15 to 20 times multiples higher than what we made on the real estate side of the business. But so that's the hard part. You know, we're taking on the risk of venture capital, but with the returns of real estate that are a little bit more muted, but obviously with the safety of owning a hard asset.
John,
thank you for that.
I have a question for Joe.
Yes.
Joe, I know that Alexandria invests in these VC firms as part of their strategy. You know, they use a small sleeve of their real estate capital and invest into these. Do you guys do that at Thor?
Yeah, actually, that's how we found the space. First, how we found Tech Office, or back then .com Office, was a fella named Alan Patrick, a friend of mine that had sold Apex private equity and retired at 71 and 73, came back into the space with Graycroft, saying he was gonna, that was gonna keep him young. And now at 88, he's still moving strong. And so from investing with him and that side, that's how we entered the space. And to be candid, similar was a fellow named Peter Cash, who's on our board of directors, who I've been investing with in the life science space now, if you could believe it, for 30 years. And through those investments, more particularly those around oncology over the more recent years, that's actually how we found the space, really to his credit. And also I would say, to balance out the feeling bad that we never made the returns off of all the Dropboxes and Oktas and Twitters that we had backed with their real estate spaces in the early days.
Thank you for that commercial for venture capital. It's fantastic. I thought this was a real estate webinar, but thank you.
So maybe to jump in, the confluence of tech hubs and biotech is something that we have found, particularly Bay Area, San Diego, to be self-enforcing, right? And so for my just the location perspective, that is another positive aspect of it.
We're going to start winding down soon, but another question, actually I'll start with Bert, and also obviously Tony and Brian, are UK and Europe markets ripe for life sciences? Were they a leader or are they a lagger? Where are they in this particular market? And Bert and Tony and Brian, I want to know if you're looking at those markets as well.
Yeah, so I think UK, Cambridge is definitely a location where life science is very much established and growing. But throughout Europe, it's still in a earlier stage of development. Let's put it that way. There are some university hubs that are emerging. But it's certainly not to our knowledge, at the scale of what is available in the US.
Ryan?
Thanks, Jonathan. We are looking, although we're not able to travel to the UK, which is presenting, significant challenges. IQHQ does have, ability through their documents to invest in the UK. And, the market data and research that we've studied shows that it's extremely compelling. All that said, until the travel bans and challenges related to COVID decline, I don't think it's realistic for us to really dig into an investment over there and execute. So hopefully in the next 6 months, we get good news on the vaccine front and we can all go back on getting on planes and going over to Europe. But until then, I think we're going to be in a wait and see.
And Tony, what are you looking at? Do you see Europe as a good opportunity?
I could almost echo Brian perfectly on that one. It's just too challenging us to look right now. We've got a pretty ripe backyard with enough understanding to move forward, but to get into the ex-US markets would be a bigger challenge and obstacle for us today.
Okay, and Joe and Bill, as operators and managers, how do you look at those markets?
Europe has been a very active market for us. Probably 50% of our we'll call developed market world. We're active in Latin America as well, so I'll leave that out of it. And we do believe that the opportunities are there. You look at the research triangle of the UK. You see opportunities there, Germany, Switzerland. I think that it's markets that are going to grow, particularly a post-COVID world is going to create some kind of acceleration. Interesting gossip point, UK is the first one to do an approval of a vaccine drug to get out there as of late last night or early this morning.
I think that was Merck that got the approval?
I think so.
Let's go New Jersey. So, you know, as we wind down, I'd love to get some not answers, but more feeling about the market, what our audience can walk away with and feeling more secure about the life sciences industry and what you see moving forward. I know Brian said you can't predict the future. We couldn't even predict last March. So I would just like to hear from Tony, what are you looking at, and what is exciting you now about the life sciences industry?
I'll put this in a wrapper of a bigger non-traditional for food groups context, I guess. This is part of that process for us. We're working on a 5 to 10 year long-term portfolio construction initiative that said de novo, if we had to rebuild a portfolio today, what would a long-term hold portfolio really look like in the real estate space? And we're engaging with a lot of the research groups and others out there that have similar thought processes and more PhDs on board than our staff. And the surprising answers is life science, cold storage, cell towers, a number of different areas are becoming a more permanent part of portfolios and considered to be that, as there's groups like Thor and others out there that have the subject matter expertise and longevity there. And I would venture to say that life sciences has got a role to play, will be permanent. It's just a matter of how much do you need to create the right diversification, but it's going to be it'll be just one more facet of the portfolios going forward. And I find that learning curve to be just absolutely fascinating for these next few years.
Thank you. Bert?
Yeah, I would also echo that, and we also look at the public market in conjunction with that, and getting exposure to those niches that we may privately feel that it's harder to gain access. In life science, it was actually the reverse. There's only 2 main companies in the US that are publicly listed and focused on life science, whereas other niches are much more conducive to also listed investments. So we look at it from both sides and then determine what the best way is to get the access, get the exposure.
Thank you, Bert. Brian?
Yeah, I would say we feel very good about the future for life sciences. I think as long as vacancy stays or availability stays below 10%, and in certain markets below 5%, you're going to see great rent growth. And we feel really strong about the demand profiles. As we said, a lot of this is government money, and it's not going anywhere. And so it's going to be a question of supply and how quickly it comes and how quickly it's absorbed. And so we're very excited and think the next 3 to 4 years are going to be a great time for this business.
Well, I can't think of a bigger ball to hit out of the park, Bill. Maybe you want to take it from here.
I again, building on the enthusiasm that Tony, Brian, and Bert have expressed within life sciences, I wholeheartedly agree. I will say, after being in this industry for over 20 years now, there is the space is maturing, but it has been around. There are experts in the field, and that's at Thor Sciences. We pride ourselves on that. But going forward, it's only growing, and we're looking to capitalize on that, not just in the primary markets that were mentioned today, from Boston, San Fran, and San Diego, but there are other markets that have been very fundamentally strong, as Joe pointed out, New Jersey, that northern mid-Atlantic, through RTP. And then the UK, I see tremendous growth there in third-party ownership of R&D space. So very excited about the future.
And in closing, Joe, we only have a few seconds. Love to hear some wrap-up remarks.
I think that you look at the global world of opportunities, and I think of the real estate industry often studying Warren Buffett, studying the stock market, and you have your choices, growth versus value. And we've chosen a path other than the exceptions of 01, 03, and call it 2009 to 2013 to lean more on the growth. And both in our business to business side with the sciences side, and with our business to consumer with our e-commerce logistics side of the business, we see no more exciting opportunity for growth, and we see a market that's years and years ahead, and it's a fun space to play in. You feel good that you're making the world a better place, making people healthier, and advancing society. So it's a lot of fun, but it's not for amateurs. It's like I often describe the life science business as like playing polo. I happened to years ago play polo, and I said to someone, they said, "Do you really need to be careful so that you don't get hurt?" I said, "The problem with polo is it's not just you; it's the other players on the field, and really knowing what you're doing, other than like traditional horseback riding." And so I think of life science the same way. But again, a fun space, great space. And a pleasure being on with Tony, Bert, Brian, and yourself, Jonathan, and Bill today.
Well,
thank you.
Great way to wrap it up. Thank you, gentlemen, for joining us on this Life Sciences Investor webinar. I want to thank our sponsors, Thor and Juniper Square, and most important, our audience for attending and for all your great questions. As I said, if anything has not been answered, we will follow up with that. Have a great day, everybody. Thank you.